Well, the dollar has held up very well over the last 2 years, primarily because the US economy has outperformed the rest of the world. We're seeing a little bit of a change in that. We see a further deceleration in US real GDP growth in 2020 from about 2.3% this year to 1.8% next year. Even for the fourth quarter of 2019, some of the data is coming in a little bit weaker than expected, like retail sales on Friday. Then the Fed, on top of that, we had the final meeting last week. They gave a very clear message that the bar for raising rates has been raised. And now it's not just about getting inflation to 2%, it's getting inflation to 2% and staying there persistently. So that means the timing of that first rate increase has been pushed out. And then the Fed finally is aggressively expanding its balance sheet, partly for term end demand, but also they are buying 60 billion worth of treasury bills per month, and that will continue through until the middle of next year. As you can see here, assets on the Fed's balance sheet is expanding rapidly. In fact, the pace of expansion is the fastest since the great financial crisis. So all of these factors combined, and we think that the prospects for the US dollar are certainly not as positive for 2020. Not fully. Certainly on the rest of the world component of the relative change between the US and the rest of the world, we don't have as much conviction as we do on the US side. We do see signs of stability. Certainly the sentiment indicators from Europe, some of them have shown some notable turnaround. The Centex index in Germany, the ZEW, but then the PMI manufacturing from Germany was weak again. So growth in Europe remains weak, remains fragile, but we're certainly not expecting a further downturn. And again, relative to the continued slowdown in the US, that's a little bit better in terms of non-dollar currency prospects for 2020. We've also had some good data from China. We've had the US-China trade deal. While we think that's not going to remove the uncertainty, it does de-escalate the high tensions we've had at the moment. So all in all, the prospects for the rest of the world look a little bit better for 2020 than they did in 2019. Well, certainly, short term, we've had a removal of uncertainty in relation to the withdrawal agreement itself. So we're going to leave the EU on the 31st of January. So that's a positive. But of course, we then go into free trade agreement negotiations, and there's plenty of uncertainty ahead. The idea that UK corporates, medium to small firms are going to suddenly start investing while the UK is negotiating the details of a free trade agreement, we think is very unrealistic. So we're not expecting much of a bounce back in domestic demand in the UK. In fact, we're expecting the Bank of England to cut rates in the second quarter. So while the prospects for the pound versus the dollar look quite good short term, we wouldn't be surprised if we saw some reversal in those gains as we move into 2020.